Imagine waking up and your card suddenly declines at the grocery store. You check your banking app, your account is frozen, every penny locked without warning. No payments, no cash withdrawals, no access to your own money. You call the bank, and they won't explain why. Not because they don't want to, but because they're legally not allowed to tell you. It doesn't take a crime or a court case for this to happen. Ordinary people across the UK are experiencing it right now. The question is no longer, can it happen, but how easily could it happen to you next?
Number 1. Legal powers and framework behind account freezes. The UK government and financial institutions operate under a strict legal framework that enables bank accounts to be frozen under specific circumstances. This authority mainly comes from laws such as the Proceeds of Crime Act, POCA, Anti-Money Laundering regulations, and counter-terrorism and sanctions laws. These laws empower authorities to temporarily restrict access to funds if they suspect money laundering, fraud, tax evasion, terrorism financing, or financial crimes. Banks are legally required to take action even if the investigation has not yet been completed, meaning money can be locked instantly while checks are carried out. The purpose is said to be protection of the financial system and prevention of criminal exploitation, not inconvenience to ordinary citizens. Once a freeze is placed, the account holder cannot withdraw, transfer, or make payments, which can severely disrupt daily life. Banks are not allowed to warn customers beforehand because tipping off a person under investigation is considered a crime under UK law. This creates an environment where a normal and innocent individual might wake up one morning to find their bank card declining without explanation. The freeze usually lasts up to 31 days, but the authorities can apply to court to extend this period to up to 7 months and, in complex cases, even longer. During this time, day-to-day transactions such as rent, bills, salaries, and online purchases remain blocked. This legal power highlights how broad the system has become and how easily it can affect regular people. Even standard activities such as receiving large international payments, frequent cash deposits, or involvement in high-risk business categories can trigger automated financial scrutiny. The framework exists to combat serious crime, yet it also creates a scenario where citizens may feel vulnerable because their financial access can be restricted without a court conviction or formal charge.
Number 2. Why bank accounts get frozen. Bank accounts in the UK are most often frozen because of suspicion-based triggers, not confirmed wrongdoing. Banks continuously monitor customer transactions using advanced algorithms that flag unusual patterns. Examples include sudden high-value transfers, large cash deposits, international payments from high-risk countries, or receiving funds from multiple unrelated accounts. Even selling products online or cryptocurrency trading can trigger scrutiny if the activity does not match what the bank expects from the account holder's usual behavior. The freeze is applied first and questions are asked later, which is why many people experience it without ever being told what caused it. Banks freeze first to stay compliant with government regulations and investigate afterwards to avoid penalties. Another major reason is AML, anti-money laundering risk assessments linked with business activities. Individuals who run small e-commerce shops, deal in digital payments, handle client deposits, or operate in industries labeled as high risk can face freezes faster than others. Sometimes very normal and legal actions, such as receiving a big family transfer from abroad, rapid increase in bank turnover, or depositing savings from cash-based work, may appear irregular to automated systems. Tax-related concerns also trigger freezes when the bank detects earnings that look inconsistent with the customer's declared income. In these cases, HMRC may get involved and the account can remain frozen while documentation and explanations are reviewed. Banks may also freeze accounts to protect the customer, not just for regulatory enforcement. If they suspect hacking, identity theft, or unauthorized card activity, they can block outgoing transactions until contact is made with the account holder. This shows that a freeze isn't always a punishment, but can be a defense mechanism when cybercrime risk is detected. However, the challenge for customers is that all freezes look the same from the outside. Card declines, payments fail, and the account becomes unusable without advance notice or immediate explanation.
Number 3. Who can freeze an account? Most people assume only their bank can block access to their funds, but in the UK, multiple authorities have the power to freeze bank accounts under different legal contexts. High street banks, such as Barclays, Lloyds, HSBC, NatWest, and digital banks like Monzo or Revolut, can trigger a freeze when automated compliance systems detect suspected financial crime, fraud, tax irregularities, or unusual activity. These banks are legally obligated to act immediately, because delaying a freeze can result in penalties from regulators. At the government level, bodies such as HMRC, the National Crime Agency, NCA, the Financial Conduct Authority, FCA, and Counter-Terrorism Command can request banks to stop access to funds while they carry out investigations. Even local police forces can request temporary freezes when fraud or crime is suspected. Outside of criminal or suspicious activity, certain civilian and civil enforcement agencies are also legally empowered to place restrictions on accounts. HMRC can freeze or seize funds related to unpaid taxes or unexplained income, while the Child Maintenance Service can request banks to restrict access if a parent consistently avoids court-ordered financial responsibilities. Courts can ask banks to stop outgoing transfers during legal disputes, such as divorce settlements, debt recovery, or business litigation. In these cases, the freeze is not based on criminal suspicion, but on legal obligations or financial accountability. Private creditors cannot freeze bank accounts on demand, yet they can obtain a court order which leads to a bank-executed freeze through enforcement offices. The broad network of institutions with authority to restrict financial access shows how interconnected the UK banking and legal systems have become. A freeze isn't always rooted in crime. Sometimes it results from administrative disputes, unpaid liabilities, or even third-party complaints. What makes this landscape more complex is that the account holder is rarely informed before the freeze occurs, leaving them unaware of which institution initiated it and why.
Number 4. Suspicious activity and anti-money laundering triggers. Modern UK banks rely on automated monitoring systems designed to detect unusual financial behaviour under anti-money laundering (AML) regulations. These systems scan every transaction in real time and compare activity against an individual's historical financial patterns. Sudden spikes in income, frequent deposits that don't match a person's employment profile, international transfers from regions classified as high risk, or payments sent to unfamiliar business accounts can trigger suspicion flags. Cryptocurrency trading, online marketplace payments, social media-based business transactions, and receiving funds from many unrelated senders are also on the radar. When any activity appears to fall outside the customer's normal profile or lacks a clear financial purpose, the system can automatically initiate a freeze while compliance teams gather more information. This means that even completely legal income can lead to a freeze if it appears unusual to the bank's risk model. Businesses face an even more delicate situation because banks are especially cautious with industries considered high risk from a financial crime perspective. These include e-commerce stores, digital marketing services, property flipping, money exchange operations, and investment-based businesses. If a company has irregular turnover, delayed supplier invoices, repetitive refund patterns, or inconsistent cash flow, the system may view it as a potential money laundering risk. Even using different payment processors or switching platforms frequently can raise concerns. Some individuals trigger freezes simply because they move money between personal and business accounts in a pattern that appears complex. When the system cannot clearly trace the economic purpose behind funds, it freezes first and asks questions later. Every trigger eventually leads to a source of funds review, where the account holder must prove where their money came from using documents such as invoices, contracts, tax returns, bank statements, online sales reports, or business records. If paperwork is incomplete or slow, the freeze can continue for months. This highlights the importance of clear records and transparency, not only for compliance, but also for avoiding unexpected disruptions to everyday financial access.
Number 5. Debt recovery and tax powers. Debt and tax-related freezes operate under a different legal mechanism than criminal investigations, yet they are equally powerful and disruptive. HMRC has the authority to freeze funds if they believe taxes are owed, undeclared income exists, or financial records do not align with earnings. This power is used more frequently now due to digital monitoring of income from online businesses, freelancing, e-commerce, property rentals, and overseas remittances. People often face freezes not because of intentional wrongdoing, but because their declared income on tax filings doesn't match bank activity. High-value deposits from family, informal savings, or cash-based work can be interpreted as undeclared earnings, leading to a bank lockdown while HMRC requests proof, receipts, and explanation. During this time, access to funds remains restricted until the investigation is resolved. Debt enforcement creates another pathway for freezes. Courts can issue a third-party debt order, compelling a bank to block funds to secure repayment. This applies when someone owes money due to missed loan payments, unpaid credit cards, unresolved business disputes, or personal lawsuits. The Child Maintenance Service can also request a freeze when a parent does not meet court-ordered payments. In these cases, the freeze is targeted rather than suspicion-based, meaning the goal is to secure repayment rather than investigate criminal behavior. The individual often learns about the freeze only after enforcement has taken place, which can cause sudden financial hardship, bounced payments, and inability to access personal savings. The challenge is that many people are unaware of how easily tax discrepancies or legal debts can escalate into full financial restriction. A freeze does not require a conviction, final judgment, or proven fraud. It only requires authorities to believe that money may be owed or that income reporting may be inaccurate. This creates a system where everyday financial mistakes, late payments, unfiled tax documents, or informal business dealings can unexpectedly trigger powerful enforcement tools that restrict access to personal funds until the issue is resolved.
Number 6. Sanctions, terrorism, and asset freezes. Asset freezes linked to sanctions and counter-terrorism regulations are among the strictest forms of financial restrictions in the UK. These freezes are not limited to people directly tied to criminal activity. They can apply to individuals or businesses connected indirectly to sanctioned countries, flagged organisations, or high-risk financial sectors. The UK sanctions list is updated regularly, and banks are required to screen customer transactions against it. If a transfer even passes through a sanctioned entity, or if a customer receives money from someone listed, the bank can instantly block access. This extends to crypto wallets, online remittance platforms, and business partners located in sanctioned regions. The freeze is mandatory until the risk is fully analysed, meaning the customer must prove that funds have no link to terrorism financing or sanctioned groups. These freezes often occur without warning because banks are legally prohibited from informing customers in advance. Even innocent interactions, such as paying suppliers in restricted regions, receiving funds from relatives abroad in conflict zones, or engaging in international trade with unfamiliar middlemen, can trigger red flags. Banks take a risk-first approach and prefer to freeze the account instantly rather than risk regulatory penalties. Once applied, sanctions-related freezes are more complex to resolve than AML cases because the review involves government departments, not just internal bank compliance. The timeframe may be uncertain, and everyday financial activities like paying rent or business invoices remain blocked until clearance is granted. The strict nature of these regulations shows how deeply global politics influences personal banking access. People who handle overseas transactions, imports, exports, crypto payments, or freelance work for global clients face higher exposure. Even when customers have no malicious intent, the financial system operates on the assumption that any unusual cross-border activity requires investigation. This creates a world where ordinary international payments can result in restricted access to personal money simply because the surrounding geography or networks are considered high risk by regulators.
Number 7. The process. What happens when your account is frozen? When a UK bank freezes an account, the process begins silently and instantly.
The freeze is usually triggered by internal compliance alerts or government instructions. The account becomes restricted without prior notice, which means debit cards stop working, payments bounce, standing orders fail, and transfers are blocked. Direct debits such as rent, utilities, and subscriptions may decline, causing extra charges and missed payment records. The bank is not legally allowed to explain the reason right away if the freeze relates to money laundering, tax suspicion, or sanctions, because that disclosure may be considered tipping off. Customers often learn something is wrong only after repeated declines at an ATM or online checkout, creating confusion and stress while the investigation continues in the background. Within the next stage, a compliance investigation begins. Banks review recent transactions in detail and may contact the customer asking for supporting documentation. This is known as Source of Funds (SOF) or Source of Wealth (SOW) review. Customers might be asked to provide invoices, salary slips, business records, tax filings, or explanations for large transfers. If the case involves potential criminal activity, external bodies like the NCA or HMRC can take control of the investigation and request a court-approved extension. During this time, banks cannot release funds or speed up the review, even if the customer insists. Many people believe that calling the bank repeatedly will speed up the process, yet compliance departments and call centers operate separately. The only way to progress the review is by providing clear evidence that supports the financial activity under investigation. Once the documents satisfy risk assessments, restrictions are removed and access to funds returns. If information remains unclear or incomplete, the freeze can be extended while further questions are raised, meaning the outcome depends heavily on how quickly and confidently the customer can demonstrate the legal origin of their money.
Number 8, your rights and how to respond. When a bank account is frozen in the UK, people often feel powerless, yet customers do have clear rights protected by law. Even though banks cannot always disclose the reason at first, they are required to acknowledge in writing that the account is restricted and confirm whether documents are needed for review. If the freeze is based on a request from external authorities, customers have the right to request the name of the organization involved once disclosure becomes legally permissible. When paperwork is requested, the customer has the right to supply evidence such as invoices, tax records, sales reports, or salary documents to justify their transactions. Legal advisors can be contacted at any time, especially if there is suspicion of an unfair freeze, and customers can request updates regarding the timeline of the investigation. If the freeze becomes excessively prolonged, or if the customer believes the freeze is unreasonable, there are steps to escalate the situation. First, a formal complaint can be filed with the bank's compliance team. If the outcome is unsatisfactory, the next step is contacting the Financial Ombudsman Service, which is responsible for reviewing whether the bank acted proportionately. If a freeze was triggered by HMRC or law enforcement, individuals can challenge enforcement through legal representation or request a court review to determine whether the freeze is justified. These processes are not quick, yet they exist to prevent long-term financial restriction without proper cause. Documentation plays a major role in the success of these challenges because clear financial evidence makes decision-making faster. During a freeze, people can ask the bank to apply a hardship allowance, meaning limited access may be permitted for essential living expenses such as food, rent, and utilities. This is not guaranteed, but customers have the right to request it when daily life becomes affected. Understanding these rights reduces the feeling of helplessness and helps the account holder take strategic, solution-focused steps rather than waiting without clarity. The most effective response always begins with organized financial records, calm communication, and the willingness to provide proof that the frozen funds have a lawful origin.
Number 9. Preventative measures you can take. Bank account freezes often happen without warning, but there are practical steps that significantly reduce the risk of becoming a target of automated banking suspicion. The most important measure is keeping clear financial records that match the transactions flowing through your account. If you run a business, maintain invoices, receipts, contracts, and sales reports. If you receive money from family abroad, keep transfer confirmations and written explanations. When income patterns change, notify your bank in advance so the system does not treat new activity as abnormal. Splitting money between too many personal, business, crypto, and international accounts can appear suspicious, so using a structured method and explaining unusual payments early helps avoid complications.
Transparency with your bank plays a major role in prevention. For example, if you open an e-commerce store, begin freelance work, or expect to receive large payments, always update your source of income information within your account profile. Banks want to see consistency between your declared occupation and your transactions. Keeping personal and business funds separate is also a strong defense because financial patterns become easier to understand. Avoid lending or borrowing money informally through bank transfers, since unexplained movements between multiple accounts can mimic money laundering behavior. When dealing with international payments, especially from high-risk regions, always maintain documentation to prove the reason for the transfer. Cybersecurity is another overlooked preventative measure. Many freezes happen due to suspected fraud or hacking, not compliance. Use strong passwords, two-factor authentication, and avoid logging into online banking using public Wi-Fi. Report suspicious activity immediately, even if no money is lost. Banks are more confident allowing account flexibility when they see customers actively protecting their financial identity. The goal is to create a financial footprint that is consistent, well-documented, and easy to explain, reducing the chance of automated systems flagging your transactions as high risk, and protecting access to your own funds before problems occur.
Number 10. What this means for you, everyday impacts. A bank freeze isn't just a financial inconvenience, it affects almost every area of daily life. When access to money stops suddenly, even basic necessities become difficult. Rent payments fail, utility bills bounce, subscriptions cancel, and online payments decline. People with families, employees, or business obligations experience immediate pressure because salaries, supplier payments, and school fees cannot be processed. Many customers also face penalties from service providers due to failed direct debits, creating financial damage even when no wrongdoing has taken place. Emotional pressure rises quickly because there is no warning or timeline at the moment the freeze begins. The inability to buy groceries, access cash, or pay for transport can turn a normal day into a crisis in minutes. The impact is even more severe for business owners, freelancers, and online earners because a frozen account blocks revenue and damages reputation. If customers request refunds or suppliers need payment, the inability to access funds can lead to chargebacks, cancelled partnerships, and negative reviews. People who rely on marketplace payouts or international clients can suddenly lose income streams until the investigation ends. Even employers can look unreliable if wages are delayed. Because bank freezes are confidential during investigation stages, the account holder cannot publicly explain the real reason to clients or partners, which often results in misunderstandings and loss of trust. Long-term consequences also follow after the freeze is lifted. Credit scores may drop due to bounced payments, insurance premiums may rise, and loan applications may be denied because banks record the freeze internally even after the issue is cleared. Some banks close the customer's account permanently once access is restored because they consider the activity high risk. This forces individuals to open new accounts, move standing orders, and rebuild financial stability. The reality is that a single freeze can disrupt both personal and professional life long after the investigation has ended, showing how important financial planning, documentation, and banking awareness have become in the modern UK system.
Bank account freezes have become a real and growing concern across the UK, not only for people under investigation, but for ordinary citizens whose financial activity simply appears unusual to automated systems. The most alarming part is how suddenly it happens. No warning, no explanation, and no immediate access to your own money. The experience can disrupt daily life, damage business reputation, create emotional stress, and leave long-term financial scars even after the account is unfrozen. The system is built to protect the country from financial crime, yet it also exposes regular people to unexpected vulnerability. That is why understanding how freezes work, why they happen, and who has the power to trigger them is becoming essential knowledge for every bank user. Clear documentation, informed banking habits, and awareness of risk factors are now key defenses for protecting financial access. If you found this information valuable, support the channel so more people can stay informed. Like the video, subscribe for more updates on laws and financial security, and share your thoughts in the comments. Have you experienced a bank freeze or know someone who has? Your voice might help someone else avoid the same situation.